Somebody call a doctor because the American economy is bleeding out, and nobody in Washington wants to admit it. The dollar has dropped 10% since Trump's inauguration day. Manufacturing lost 70,000 jobs in 12 months under this administration. Tourism revenue collapsed by $50 billion despite having the weakest dollar in years. And in January alone, U.S. employers announced 108,000 job cuts, a 118% increase from last January. But here's what makes this absolutely insane. The stock market is hitting record highs. GDP growth is over 4%. Corporate earnings are beating projections. By every metric the Trump administration points to, the economy is thriving. So what the hell is actually happening here? We're going to break this down in 3 parts. First, we'll look at what the smartest bond trader on Wall Street is warning about the job market collapse. Second, we'll expose how Trump's 2 main economic bets are both failing spectacularly. And third, we'll show you why the policies they're bragging about are actually making things worse. Stay with me, because by the end, you'll understand why this economy is heading for a cliff, even while the stock market parties. Let's start with the guy who sees what's really happening, Rick Rieder. As the manager of a $2.5 trillion fixed income portfolio at BlackRock, he's arguably the most important bond trader in the world. And what he told Bloomberg this week should alarm anyone paying attention. We haven't had jobs day in months because we're not getting any jobs. The last 3 months, we've had negative employment. You look at the JOLTS report, the Challenger job cuts, the claims data, the ISM services numbers. There's no ambiguity around where we are in the jobs market. We're having a really tough time. Now, Rieder was briefly considered for Federal Reserve Chair before his support for higher corporate taxes and Democratic donations apparently disqualified him. But his analysis cuts through the noise because bond traders, unlike equity analysts and cable news personalities, cannot afford to traffic in hype. They manage portfolios across decades. They must see the entire picture. And what Rieder sees is an economy operating on only 2 or 3 cylinders while the rest of the engine fails. The disconnect becomes stark when examining what's actually happening beneath the headline numbers. Treasury Secretary Scott Bessent spent the past week testifying before Congress, alternately defended by Republicans and attacked by Democrats. But the performance obscured the underlying reality. As one senator noted during the hearings, this was not one of them. This is not your finest day. President has put some people in very important places that are sort of caricatures of incompetence. That's not you. Today was not your finest day. Look, the criticism wasn't about Bessent's competence. It was about the impossible task he's been handed, defending an economic strategy that produces growth without employment, productivity without wages, and corporate profits without shared prosperity. Now, let me break down Trump's 2-pillar economic strategy, because this is where it gets really bad. The Trump administration's entire economic bet rests on 2 things. First, a weak dollar to boost manufacturing and tourism. Second, massive capital expenditure toward artificial intelligence to increase productivity. Both are failing to deliver what they promised. Let me show you how. Start with the dollar debasement strategy. The logic appears sound on paper, right? A weaker currency makes American goods cheaper for foreign buyers and makes the United States a more attractive tourist destination. Manufacturing should surge. Tourism should boom. But manufacturing employment contracted by 70,000 jobs in 2025, and according to the Financial Times, travel to the United States from outside the country dropped 4.2% last year, a $50 billion loss in tourism spending. Global tourism surged during the same period, meaning the demand existed. The exchange rate advantage existed, but the customers went elsewhere. Think about that for a second. The world wanted to travel. The dollar made America cheap, but they still didn't come. Why? The reason has nothing to do with currency values and everything to do with perception. No favorable exchange rate overcomes the reputational damage of Trump's policy chaos. International manufacturers don't build new capacity in countries with no coherent industrial policy, where tariffs appear and disappear unpredictably, where the head of state might start a conflict with an ally or impose 100% duties on a supplier without warning. And tourists don't vacation in nations that appear hostile or unstable, regardless of how cheap the hotels become in their home currency. Trump's erratic behavior is costing America billions in lost tourism and manufacturing investment. But wait, it gets worse. Now let's talk about the second pillar, the AI investment boom. Meta, Alphabet, and Amazon announced combined capital expenditures exceeding $650 billion for 2026, primarily directed toward data centers and AI research. Markets initially celebrated these announcements. Then something shifted. The stocks sold off despite beating earnings projections. The market is finally understanding what this investment actually means. When Anthropic released new models capable of handling complex legal and financial tasks with minimal human oversight, software stocks lost $2 trillion in value within days. Not because the technology failed, but because it succeeded. The AI tools demonstrated they could replace entry-level knowledge workers, the junior analysts, paralegals, and programmers who have traditionally filled office buildings and justified commercial real estate values. This is what Reader meant when he said productivity is exploding while the job market struggles. And here's the thing you need to understand about productivity. Productivity, by definition, means doing more with less. And in this case, less means fewer people. It's us. The more successful the AI investments become, the fewer workers companies need. It's a paradox that economic models built for industrial manufacturing never anticipated growth that eliminates the jobs it was supposed to create. Now, let me show you the actual numbers because they're devastating. The labor market data from multiple sources confirms this structural shift. ADP, which tracks private sector employment, reported that employers added only 398,000 jobs in all of 2025, down from 771,000 in the prior year. January 2026 started with just 22,000 new jobs. Nella Richardson, chief economist at ADP, noted the composition matters as much as the total. Professional services got hammered. The only significant growth came in education and healthcare, driven almost entirely by an aging population requiring more medical care. This isn't productive economic expansion, it's demographic inevitability. Challenger Gray and Christmas, which surveys CEOs about planned hiring and layoffs, released even more troubling numbers. Their data showed 2025 was the largest year for announced layoffs outside of COVID in a decade, not by a small margin, by a substantial one. And January 2026 set a new record, the lowest number of planned hires announced in any January going back 10 years. Companies aren't preparing to expand their workforces. They're preparing to contract them. The JOLTS data from the Department of Labor confirmed the trend. Job openings declined by nearly 400,000 in December alone, falling to 6.5 million total. Year over year, openings are down by almost 1 million positions. At the same time, initial unemployment claims jumped to 231,000 in the final week of January, an increase of 22,000 over the prior week. Fewer openings, more claims. Declining hours worked. Every single indicator points the same direction. Yet GDP growth remains robust at over 4% in the third quarter, with predictions of 5% for the fourth. This is the paradox Ryder identified. The economy is performing extraordinarily well if the only measure is capital flow. Corporate earnings are strong. Stock buybacks continue, mergers and acquisitions proceed. But none of this requires employing large numbers of people anymore. In fact, it increasingly rewards companies for employing fewer people more efficiently. Look at which sectors are actually growing. Healthcare is expanding because the population is aging. More cancer treatments, more cardiac interventions, more end-of-life care. This contributes to GDP, but reflects demographic decline, not economic vitality. Financial services are growing because wealth concentration creates demand for asset management. Utilities are expanding because data centers require massive power draws. Insurance is up because climate disasters and social instability increase risk. These are not the markers of a healthy, broadly shared economy. They're the markers of an economy serving an increasingly narrow slice of the population while the foundation crumbles. Ryder put it bluntly in his Bloomberg interview. This is an economy that's more asset-oriented than labor-oriented. We have a problem. We need to employ more people. He's bullish on emerging markets instead, where labor still drives growth and consumption is expanding among middle classes. The implication is clear. The growth story in mature economies like the United States is finished. The model of shared prosperity through employment is over. What remains is capital-chasing returns in markets where labor costs are low and consumer demand is rising. Now, here's where the Trump administration's defense completely falls apart. The Trump administration's defense of its working-class credentials rests on policies like eliminating taxes on tips and overtime. But consider what these policies actually mean in the current environment. The no tax on overtime provision only applies to half the time and a half rate, meaning it covers 1/3 of overtime pay. And it only matters if overtime exists to be worked. But hours worked are already declining as companies use technology to reduce labor needs. No tax on tips helps service workers only if the service sector is thriving. But tourism is down because of Trump's behavior, and only high-end dining is growing, precisely the segment that doesn't need the tax relief. These policies operate in a context where larger economic forces move in the opposite direction. Thanks for nothing. And let me show you the most disgusting example. Washington Post layoffs. Jeff Bezos' company released a $50 million documentary about the First Lady, then immediately eliminated 300 jobs, the entire sports department, and most overseas journalists. This while Bezos' net worth continued climbing and Amazon announced billions more in AI spending. But 300 jobs is a rounding error. Challenger reported 108,000 announced job cuts in January alone, a 200% increase over December. Now, here's why traditional economic fixes aren't working. When GDP growth is the primary success metric, any activity that increases GDP counts as positive. Capital expenditure toward automation increases GDP. Healthcare spending increases GDP. Stock buybacks increase GDP. An economy can register strong growth while employment collapses because growth no longer requires broad-based employment. So let me paint the picture. The real economy where people work and earn wages is contracting. Manufacturing down, tourism down, hours worked down, job openings down. This is what most people experience. But there's a different economy operating simultaneously. S&P 500 hits records. Corporate profits grow. Asset values appreciate. Both sides in policy debates are correct. They're describing different economies in the same geographic space. But here's what's different this time. The displacement is happening in sectors that were supposed to be immune. Knowledge work, professional services, creative industries. These were the fields workers were told to retrain for. Now, artificial intelligence handles legal research, financial analysis, software coding, customer service, content creation. The ladder workers were told to climb is being removed rung by rung. So here's the question nobody in Washington wants to answer. How long can this continue before something breaks? An economy producing increasing output while employing fewer people faces a fundamental problem: consumption. If employment income declines, who buys the products? The answer so far has been debt finance consumption by workers and wealth effect consumption by asset holders. Neither is sustainable. Debt has limits. When the next shock arrives, recession, financial crisis, geopolitical disruption, the debt burden becomes a crisis accelerant. Wealth effect consumption is equally fragile. When asset values decline, consumption by the wealthy drops sharply because it was based on paper gains that disappear overnight. The Trump administration's bet is that technology will generate enough productivity gains to offset these problems, that AI will create new industries. But nothing in the data supports this. The technology is succeeding at eliminating labor costs while failing to create compensating opportunities. Rick Reeder sees this clearly because bond portfolios require realistic assessments. His assessment: mature economies like the United States have structural problems conventional growth metrics obscure. The growth is real, the profits are real, but they're building a narrower, more fragile system that serves capital while discarding labor. This is why Reeder is bullish on emerging markets. Those economies still have expanding middle classes and consumption-driven growth. The same automation that eliminates jobs in New York creates jobs in Jakarta. The pattern will continue until it cannot. The current trajectory produces concentrated wealth, declining employment security, and fragile consumption dependent on debt and asset bubbles. These are the characteristics of a system approaching a breaking point. Labor is the biggest casualty in the Trump economy. The labor market will continue deteriorating because the economy is evolving toward a structure requiring less labor. More layoffs will come. Fewer jobs will be created. Hours will decline. And through it all, GDP might continue growing, stocks rising, profits expanding. The disaster and the boom will coexist because they're happening in different economies that share only geography and currency.